Okay, recording has started. A quick recap from last meeting. We have began our discussion on financial statement analysis for mutual fund companies. Mutual funds. Mutual funds are investment vehicles made up of pool of monies collected from investors for the purpose of investing in securities, stocks, bonds, and money markets. Imagine it this way. A mutual fund company has the following balance sheet. On the right side will be the source of funding. It will come directly from the savers. The people with extra money would purchase a share of stock in the mutual fund. Now the money collected will be used to purchase stocks, bonds, and money markets. Stocks, bonds, and money market securities. The investor will have a pro rata participation in the gains as well as losses in these investments. So when you talk about mutual funds, they are operated by money managers. They rely on the expertise of the money managers, which is the investment advisor or the fund manager, or the investment advisor. Okay? What basically happens is the mutual fund company will invest in different securities. Some would invest in stocks, some would invest in bonds, others would invest in a mixture of different funds. We use the term portfolio for a basket of securities structured and maintained to match the investment objectives. Each mutual fund has an objective. By this time, I believe that you were able to see different types of funds already because I've already assigned you homework. Siyempre, lahat naman homework kasi lahat naman tayo nasa home. I have assigned to you exercises. Okay? So, example of an investment objective is growth. If the investment objective is growth, then what kind of stocks would the mutual fund company invest in? Definitely, it will be companies which have good growth prospects. Companies with very good growth prospects. Okay? Next. What about liquidity? If the objective is liquidity, then the shares should not be the shares. The money raised from selling the mutual fund company's shares should not be invested in stocks, even bonds. Bonds are for the long term. It should be placed in very liquid instruments, which we call money markets. So if the goal is to be liquid and at the same time earning a little amount of return, money market funds would do. Okay? There's a trade-off between profitability and liquidity. The more profitable an asset is, the less liquid it is. The more liquid it is, the less profitable. Now, money markets are almost equivalent to cash. They are readily saleable. So money market securities are not that profitable. You'll just earn 1%, 2%, 3%. The most. The most is 4%. Okay? Money market securities. On the other hand, if you invest in riskier securities like stocks, the values fluctuate significantly on a day-to-day basis. However, in the long run, there's a high chance that it would give higher returns. Okay. Each shareholder participates proportionately in the gains and losses of the funds. So if the value of stock A would go up, each shareholder would receive a pro rata. A pro rata meaning it's this percentage increase in the stock, less any expenses. The concept of net asset value per share is almost comparable to a stock price. NAV PS, net asset value per share. It can be calculated by deducting the value of assets by the value of liabilities, if any, to arrive at the value of equity. So assuming there is no liability, imagine nyo na walang liability, you take the value of assets, that's also the value of equity. Again, in a simple example where there's no liability, assets is equal to equity. Otherwise, just deduct the value of liability. Assets minus liability would be equity. So we use the word market capitalization to refer to the overall value of the equity. The shareholders' equity value, we call it market participation. Market capitalization. Market capitalization. So the value of one share can be arrived at, also known as the NAV-BS, net asset value per share. Market capitalization, which is the, again, value of equity, divided by the number of shares outstanding. Now, I use the word mutual fund to refer to both the investment and the company as well. Okay? Now, the main reason why a saver would opt to invest their money in a mutual fund is for the purpose of diversification. As told to you last time, this is not necessarily a good thing in the real world. Okay? In modern portfolio theory, diversification is a good thing. Why? If you invest your money in one company, if that company goes bankrupt, all of your money will disappear. However, if you invest in 5, if one of them is lost, you have 4 other companies who are going to offset those losses. That's the concept of diversification. The fund manager should act in the best interest of the shareholder. The fund manager, remember, is the one in charge of overall of the mutual fund. The fund manager is going to act as the investment advisor. Ideally, the fund manager should act what's best for the investors. Analysts would report to the fund manager. The analyst should report to the fund manager. The job of the analyst is to recommend a stock or a bond pick. The analyst can spot which stocks or bonds are good to buy. Okay. Fund accountants are in charge in calculating the net asset value per share on a day-to-day basis. Again, the net asset value per share is calculated on a day-to-day basis. Any fluctuations in the value of the portfolio, as seen in the formula, would have an effect on the value of one share. Assuming no liability, the value of all of these assets is the value of the equity. Divide it by the number of shares. There you go. That's the NAV-PS, the net asset value per share. Other personnel in the company includes the compliance officers and the attorneys who are in charge in making sure that the mutual fund company complies with the regulatory and legal requirements. Okay, what are the fees related to operating the mutual fund? The fees that need to be paid related to the operations of the mutual fund. Again, a quick recap. It consists of 2 sets. The first set is ongoing annual fees. These are fixed. They do not vary with the number of transactions. Kahit ilang beses ka bumili ng mutual fund o magbenta dahil ayaw mo na, okay? The ongoing annual fees are not dependent on such. They pertain to the annual operating fees of the mutual fund company, including the advisory and management fees. In theory, you are paying for the expertise of the fund manager. You're paying for the expertise of the fund manager. Transaction fees. Transaction fees would vary for every transaction that you make. If the investor will buy or invest, money will go into the mutual fund. If the investor will sell, if the investor will sell back to the mutual fund company, in other words, ano yung word na yan? Redeem. If there would be redemption, then money will go out from the mutual fund company, ibabalik kay investor. Commissions are the common transaction fees. They are paid to agents. As I have told you, there are mutual fund companies who operate together with insurance companies. And they have agents who are going to put the money in. Front-end load happens, when does it happen? At the time, money is put into the mutual fund company. When the investor will buy the mutual fund share, in other words, the investor will put money into the company, that investor will have to pay front-end load if it is based on such. Okay? However, there are mutual fund companies who do not charge a front-end load. However, their agents would charge a back-end load. So, when the money will be redeemed by the investor, when the money will be taken back by the investor, that's the time when the agent charges the commission. Ulitin ko ha, emphasize ko. Pagpasok ba kayo ng pera sa mutual fund, the mutual fund company will receive the money. If there is a front-end load, the commissions will be paid at that time. On the other hand, if you are going to redeem the mutual fund money that you have entered, you're going to take back your money already. In other words, the mutual fund company will have an outflow of cash to the investor. If that is the time when the agent will charge commission, there is a back-end load. Back-end load, rather. Okay? Front-end load, it happens during the time of where the investor purchases the mutual fund stock. If it will be paid as a result of the investor going to the investor being able to redeem back the money, that's a back-end load. There are other fees that happen on a per transaction. The agent. Redemption and purchase fees. Purchase, when you're going to put money to the mutual fund. Redemption, when you're going to take back your money. These fees are going to be paid to the mutual fund and not the agent. Okay? So again, there are mutual funds who would operate by having agents buying and selling, having agents selling the mutual funds. Commissions are paid to them. If that is not how they operate, there would be redemption and purchase fees not payable to the agent. Now, there are those mutual fund companies who do not want you to keep on withdrawing money. They charge an early withdrawal penalty. Okay? I think that's the thing that I would have to emphasize based on your questions last meeting. If there are further questions, please raise them now. Okay? So let's now proceed to the advantages and disadvantages of mutual funds. Okay. The advantages of mutual funds include diversification. Putting your monies in different baskets, putting your eggs in different baskets would make it safer for you. Assuming that one basket will go down, you still have other baskets. Economies of scale. When we are going to pool our money together with other investors, some of the transaction costs would disappear or become very low. So if you are going to hire your own manager, fund manager, maybe it's expensive. So what you're going to do is you're going to team up with other people in order to dilute the cost of operating the investment vehicle. Easy access. Some mutual fund companies are partnering with insurance companies. Some are partnering with banks. So we can easily access them at a very low cost, 5,000, 10,000 pesos to open. Professional management by the fund manager. Variety and choice, depending on your objectives. I'm moving to that topic later. Then finally, transparency. The NAV PS is calculated on a day-to-day basis. What's the disadvantage in having a mutual fund account. Now, the disadvantage includes the following. The returns are fluctuating. By the way, unlike banks which have PDIC insurance, mutual funds do not have such insurance. Fluctuating returns. The NAV PS can go up and down, up and down, up and down. And the riskier it is, the more volatile the price of the mutual fund becomes. Cash drag. Cash drag, as I have told you, sometimes the mutual fund company would leave a portion of their assets in the form of cash. In the event that someone will withdraw their money, there's a readily available cash. The problem with that is that when there is cash, that money is not invested in stocks and bonds. Okay? So the presence of a cash drag of cash in the balance sheet means the mutual fund companies are not earning for that portion of the funds. Costs, I have already discussed what the costs are, including the commissions. You have to pay a commission. You have to pay the fund manager, regardless of the performance. Now, here's unfair for mutual funds. When the investment manager will not give you a profit, they still are entitled to charge you their salary. Okay, their salary. So that's really not good. However, that is how it works. So in the mutual funds, assuming that your year-on-year gain is negative 20%, the fund manager will still have to be paid. Kahit na nalugi kayo ng 20%, wala silang pake. Kailangan mo pa rin bayaran yon. Diversification. Diversification. Now, here's the thing. It doesn't follow that when you are diversified, you are going to have the best optimal return. You're going to have the highest possible return. The problem with diversification is that it can become worse. Diversification. There is really no such term. This is only an amalgamation of diversification and having it worse. Now, some mutual funds, their managers are not really that good. Their analysts are not good. They just keep on diversifying for the purpose of diversifying without really studying the funds well. Kahit pa gaano sila ka-professional, hindi naman lahat ng professional magaling. Okay? So they keep on investing their money wherever, and at the end of the day, you would end up with less returns than it would have been if you invest only in one company. So the problem here is it can go worse. No? Being diversified is not necessarily a good thing. Fund management, again, this is related to costs. Sometimes the managers really are not the experts. Evaluating funds. Now, when you compare the funds, let's say Let's say the funds of FAMI. FAMI is First Asia. Alam niyo yan? First Asia. FAMI. You can search FAMI. Let us say the returns of FAMI is 5%. The returns of ALFM, okay na kayo, no? Nabasa niyo yung ALFM. Let's say the ALFM bond fund earns only 4%, while the equivalent in FAMI is 5%. Now, does it necessarily mean that in the future, FAMI will outperform still in the year to come ALFM? It doesn't matter. It doesn't follow. Okay? You cannot really compare the performance of different mutual funds. It's not an easy thing to do. It's really difficult. You have to adjust for risk. Again, it includes a lot of statistics. It would be discussed maybe in a different subject. Okay? So here we go. This is the new part of the lesson. How do investors earn? Now, again, What happens here is that the investor is going to purchase a share of stock in the mutual fund company. The investor is going to purchase a share of stock in a mutual fund company. How will the investor earn? Now, one way is when the dividends are paid to the mutual fund. Let's say company A. If the mutual fund company has invested in company A and company A declared dividends, those dividends will go to the mutual fund company. So mutual fund company invests in company A. Company A is going to pay dividends. The dividends are now going to increase the asset value. When the asset value goes up, the equity value also goes up. Divided by the number of shares outstanding, there should be a proportional increase in the share of stock of this person, this investor. In the case of bonds, wala namang dividends sa bonds, diba? Bonds earn interest. So interest income goes to the mutual fund company. Then again, it will be distributed via the increase in the NAV-PS to the investor. Tataas yung asset natin dito dahil magbabayad to ng interest, magbabayad to ng dividend. So stocks earn dividends, bonds earn interest. The asset value will go up. So if the asset value will go up, the equity value also goes up because assets is equal to equity, assuming there's no liability. Then divided by the number of shares outstanding, the NAV-PS will go up. The second way is when fund securities increase in price and then are sold. We call this realized gain. If the value of the stocks of company E went up, the mutual fund company can sell the stock. Ibebenta niya si E. When they are sold, when the stocks of company E are sold, ano mangyayari? When the stocks of company E are sold, then there you go. Okay, mas mataas yung nabenta kesa yung binili. Fund securities increase in price and then sold. Mas mataas yung benta sa bili. The selling price is higher than the cost of purchasing it. Or, when the fund securities increase in price, but yet, it's not yet sold. If company E's stocks are not yet sold, we call that unrealized gain. So, dalawa ang pwede maging gain, no? There are two possible types of gain. Gain which is converted into cash, which we call realized gain. Gain which is not yet converted to cash. The securities are still being held. We call it unrealized gain. Okay? Unrealized gain. So again, you purchase company E's stock at 5 pesos. Example lang ha. You purchase the stock of company E at 5 pesos. From 5 pesos, it became 8 pesos. Okay? Kumita ka ba? Yes, the mutual fund company earned. Okay? So the mutual fund company earned 3 pesos. If you are not going to sell the stocks of E, we call it unrealized gain. Fund securities increase in price, not yet sold. Okay? If you are going to sell E at 8, after you bought it at 5, we call it realized gain. Fund securities increase in price and then sold. Okay? So, whenever the mutual fund company's portfolio go up, would go up, what happens is the equity value also goes up because assets is equal to equity. Then, when the equity value or the market capitalization, another word for equity value is market capitalization. When it goes up, okay, the NAV PS will go up, and the buy and the sell price of the investor is based on the net asset value per share, NAV PS. Yun yung lumilip na parang stock price ng company. Sir, usually ba, CFA yung fund managers? Doesn't follow. No, it doesn't follow that the fund managers have a CFA certificate. However, it is not it is not required for fund managers to have a CFA title. However, it is undeniable that having the CFA title will make your work more systematic. So, ano bang inaaral niyo sa CFA? I believe that you have your review sessions for CFA. You have the option of having those review sessions for CFA. So, you are going to be taught portfolio theory. Okay, portfolio theory. You're going to be taught how to calculate the beta. So, I think kahit naman sa BAS, no? Sa BASFin, tinuro naman sa inyo yung beta calculation. How to calculate the beta. It measures the risk of holding on to the stock. Okay? The problem, however, with modern portfolio theory is that this theory is, shall I say, too academic. It is too academic. The problem with portfolio theory, it's too academic. For example, it puts a premium on diversification. Well, in fact, diversification is not necessarily a good thing, as I have described to you a while ago. Pwedeng dinamihan mo yung binili mong stocks, pero yun pala, yung mga dinagdagan mo, hindi pala maganda. They are not the good stocks. So as I've told you, yun nga, no? Having a CFA title will give you an edge. However, the problem is it's too academic. If you will compare it in practice, there's really a mismatch between practical finance and academic finance. Based on the EMH, which is disproven, efficient market hypothesis, which is disproven, CFA. Actually in CFA, you will be taught about efficient market hypothesis, EMH. Yan ba yung tinutukoy mo? Well, EMH is disproven. That's true. I actually have a video on that. You can look that on my channel, EMH. What EMH is, efficient market hypothesis. So, among the postulates where academic finance is based, there's really a lot of questions when applied to the real world. Okay. So having a CFA title does not guarantee that you're going to do great in the real world. Okay. So recap. How do investors earn? Investors earn when the value of the mutual fund company goes up. The portfolio of the mutual fund company has a lot of stocks, bonds from dividends or maybe interest will be paid by the companies whose stocks and bonds the mutual fund company bought. Up, whether it is sold or unsold, whether the gain is realized or unrealized, there is a corresponding increase in the equity value. If your assets would go up, your equity should go up, assuming there's no liability, divided by the number of shares outstanding, the NAV/BS, the net asset value per share, would go up. Now, if you are going to invest in a mutual fund company, the the NAV PS, the net asset value per share, is what you monitor. It's like monitoring the stock price. Ano kaya ang NAV PS, no? Ano kaya yung NAV PS ngayon? 100. And then after one day, it became 101. So you earn 1% in a day. After another day, it went to 99. 101 to 99, that's 2 over 101. That's almost 2%. Okay, you got my point. So every day, the NAV VS can fluctuate every business day. Okay? So you are going to base the value of your holdings on the NAV PS. Okay, if you have any questions, just raise them. What are the kinds of mutual funds? What are the kinds of mutual funds? We have the following. We have equity funds. We have equity funds. Equity funds consist of stocks. It consists of stocks, common stocks. So stock in company A, company B, publicly listed. When we say it's a fixed income mutual fund, if it is a fixed income mutual fund, then that would mean it earns interest. Ang kinikita niyan, interest. Okay? Ang kinikita niyan, interest. Fixed income. These are debt securities. Example of a fixed income fund would be bonds, bond fund, money market funds. So it boils down to what kind of securities are seen in the portfolio. Doon sa portfolio ng mutual fund, anong klaseng securities meron? Equity funds, common stocks, sometimes preferred stocks. Fixed income, it would consist of bonds and money market. Bonds are long-term debt securities. Money markets are short-term debt securities. It's also possible to have a balance fund. Balance would consist of both equity and fixed income. Combination ng stocks tsaka bonds. Balance fund yung tawag doon. Now, if we will go into the specifics, the kinds of mutual funds would also include the following. Money market funds. Money market funds are those securities that are short-term, highly liquid. They can readily be sold anytime. Bond funds are long-term debt securities. So these two are types of fixed income bonds, money market funds, and bond funds. Then we have the asset allocation funds. Asset allocation funds are mutual funds. They are a type of balance funds. But when you want to break down balance funds into two, we can call them fixed asset allocation and variable asset allocation. Example, if the balance fund is 40% equity, 60% debt, 40% equity, 60% debt, a fixed asset allocation fund, the combination should always be the same. 40% equity, 60% debt. But if it is a variable asset allocation fund, what happens is the fund manager can decide what percentage would go to equity, what percentage should go to fixed income or debt at any given time. Maybe for this time, it's good to purchase equity. So pwede siyang mag-invest ng 80% equity, 20% debt. Maybe this time, mas maganda yung fixed income. Ang gawin niyang 90% debt, 10% equity. Asset allocation funds. What about international funds? These are funds of stocks and bonds, securities that are outside the country. Okay? companies outside the country. In our case, this would consist of a fund with companies that are not in the Philippines. Now, we also have a global fund. The difference between international and global is that in international funds, it excludes our home country. Global funds, it may include our country. So, what kind of companies are in the fund? If the answer is only those that are abroad, international fund. If the answer is countries abroad as well as our country, that's a global fund. Okay, magkaiba yung international tsaka global. Special sector fund. Okay, pwedeng yung fund manager, gagawa siya ng type of fund wherein it would be on a particular sector. This fund would only include manufacturing companies. This fund would only include financial institutions. This fund would include only mining companies. So a special sector fund is a fund that pertains to a particular industrial sector. Mining, lahat lang ng mining companies. Service, lahat lang ng service companies. Regional funds, geographic area. So if you go to some funds, you would see there are Asia Pacific Fund, Euro Fund. So those companies only in those areas. So kung Asia Pacific Fund, only in Asia Pacific. Kapag Europe, Europe lang. Regional funds. And this one's interesting. This is a bit interesting. Ethical funds. Ethical funds. So some investors, they want to be morally superior. Morally superior than the rest. Okay. So if they want to be morally superior, they would buy an ethical fund. Just this year, meron akong, pero binenta ko na rin. Bumili ako ng Catholic Values Fund. Hanapin niyo yun. BPI, Catholic Values Fund. BPI, Catholic Values Fund. They invest in companies which are aligned with the Catholic values. So there are also ethical funds for those who are conscious about the types of companies where they are investing. Kunyari, ayaw nilang mag-invest sa alak. Ayaw nilang mag-invest sa casino. So, pwedeng ethical funds. Index funds. Index funds, someone has commented this last meeting, tama? May nag-comment nito last meeting. Why not just invest in the top 25 in the country? So this is what index funds do. They track the countries or the economies index. In the Philippines, we have the Philippine Stock Exchange Index. In the Philippines, we have the Philippine Stock Exchange Index. The Philippine Stock Exchange Index, this is the big 20 companies in the Philippines. The top 20 companies in the Philippines per size, as to the size of market capitalization. We call it index funds. So rather than the fund manager deciding on what stocks to buy, the index fund would automatically track the index. Kung ano yung laman ng index, pro rata, same proportion, that would be the fund composition would be. Then finally, we have exchange-traded funds. Exchange-traded funds are mutual funds similar to mutual funds. They are not really mutual funds. Exchange-traded funds are similar to mutual funds, except that when you want to get back your money, you would have to sell it to another investor. Nakuha niyo yan? Ibebenta niyo siya sa iba. So para siyang stock, no? Pwede mong ibenta sa iba. I repeat, exchange-traded funds, These are like mutual funds. They're basically a portfolio of securities, but this time they can be they can be sold to other investors in a secondary market. Pwede siya investor to investor sale. Kasi kung titingnan nyo, yung transaction na to, primary market. Yung mutual fund company, binenta niya yung share, tapos babawiin niya, ibabalik niya yung pera. These are primary market transactions. For an exchange traded fund, the investor will have to sell the fund to another investor. So yung share niya dito, ibebenta niya sa iba pang investor kung gusto niya nang makuha yung pera niya. Okay, what's the most important ratio that you would have to monitor in a mutual fund? What's the most important ratio that you would have to monitor in the sorry. Okay, what's the most important ratio that you would have to monitor for a mutual fund? It is the expense ratio or the management expense ratio. Dito nyo malalaman. Ito bang funds na to, baka naman kumukupit ng pera ko. Kunyari, nag-invest ka ng 100. Yun pala, yung 50 pesos doon, kukunin lang ng manager, pambayad ng sahod ng manager. Na i-imagine nyo. Although that's an extreme example, but you have the idea. So, a very important ratio that you have to monitor is the expense ratio. It's the annual fund operating expenses. I already discussed what the annual fund operating expense is. It includes the salary of the manager, the compensation of the manager. Divide it by the average value of the assets under management. Okay? Divided by all the value, the average value of assets under management. The value of those stocks, bonds in the portfolio of the mutual fund company. Again, that's the average value of assets under management. So, you would see, yung annual fund operating expenses, a big chunk of it would go to management fees. Okay? It will also go to distribution, services, accounting fees, and other expenses. Pero ang iingatan nyo dyan, si management fee talaga. No? Ingat kayo. Some mutual fund companies, they are charging you a lot of management fees. Okay, how do you know when a mutual fund company is paying you right? Here's the standard. As a general rule, a good mutual fund company will only take your 0.5% to 0.75% of your value per year. Example, the average value of the fund throughout the year, kunyari, nag-invest ka ng 100,000. Paano nyo malaman kung maganda yung management ng company? Hindi kumukupit ng pera sa inyo. Okay? The fair number would be, they're only going to take away 500 or 750 from the fund. Okay? So, kung nakita nyo na yung sahod niya, more than 750. 750 750 pesos kung ang pera mo ay 100,000. So imagine that you're going to invest 100,000 and then the fund is charging you only 500 or at most 750. That's already a good number. Greater than 1.5%, kunyari naniningil ng 1,500 sa'yo every year for that 100,000, that is already a bad. That's already not a good fund. Okay ba tayo doon? So if it is greater than 1.5%, it is already expensive. It is already expensive. Okay? Now, what's the problem with the expense ratio or the management expense ratio? At first glance, you cannot see it. Hindi nyo makikita agad itong expense ratio na to. The management expense ratio is actually hidden unless you are monitoring their monthly, kalimutan ko yun, no? It's KIDS. The acronym is KIDS. Their monthly KIDS. Okay? Where you would find the key data of the mutual fund. You have to monitor this monthly document, and by doing so, you can see their management expense ratio. Okay? So that's it for our discussion. Do you have any questions? Any further questions?